Okay.
So the time password.
Good evening, everyone. Uh, can anyone confirm you can hear me?
Good evening, sir. Good
Uh,
evening.
thank you. So I was using style to wait for others to join, and I think we are good to start the class now. So if you will all recollect where we stopped, I mean that's 2 weeks ago. And apologies, I could not take the classes last week. My class last week. So we stopped at I think sales variance and the previous week, and I think I chiefly chipped in variance reconciliation, which we are yet to solve a standard question on all the variances to be as a combined question. So we've just been taking them one after the other. I think somebody noted that in the group. But we are definitely going to get there before we leave the variance analysis. And this is the last segment of what we need to teach. So if we're able to finish this early, we might get our hand on a question, and maybe, just maybe, if we're able to complete it, then we can use the next class to just treat questions all through. And I will try as much as possible to get questions that will combine as much as possible of the variance that we can have. So, that being said, let's just dive into today's topic, which is the advanced variance analysis. Now, the name might sound scary, oh, even the normal variance I'm here to get now is the advanced that is coming up again. But trust me, the advanced is way simpler than the normal variance itself because the advanced is just the only thing that makes it advanced is because you have more than one unit or more than one type of material or labor or product, as the case may be. So now let me first of all mention when we use advanced variance and when we use the basic variance, which is the one we've been using. Now, if you notice, I think, oh yeah, there was a question we solved that we have various type of material. We have material A, material B, material C. Now, when you come across stuff like that, ideally, you are expected to use advanced variance. That is, when you have more than one type of either a product, which is your output, and that we are talking about your sales. If you are selling more than one goods, say you are selling fish roll, you are selling pop you are selling buns, since it is more than one, when you get to your advanced variance, I mean, when you get to your sales variance, you are expected to use the advanced variance analysis. And when you are talking about material too, so you have material A, to be say, let's say we have flour, you have butter, you have sugar, you have this and that. As far as you are using more than a material for the product, you will have to go through the advanced variance analysis for the material variance. And also for labor, you can have skilled, semi-skilled, unskilled labor. As long as you have more than a type of labor, then you are expected to go through the advanced variance. Now, note that this is conditioned to the fact that the question must provide you with information to be able to compute your advanced variance. In a case the question does not give you such kind of information, then you are free to just do the basic variance and you will get your full mark. So now, what makes up the advanced variance and advanced variance? We have just six variances there. There are six, but they can be 10, but I will usually say six. So let's talk to them one after the other. The first one I'll be talking about is the mix and the yield variance. Now, the material mix, the labor mix, the variable overhead mix all works the same way. So there's no point going through them again. And we also have the same thing for material yield, labor yield, variable overhead yield. are all the same. Now, the only one that does not have any advanced variance is fixed overhead, because fixed is always fixed. So there's nothing like advanced variance for fixed overhead. Just stick to the basic and you'll be absolutely fine. So when we talk about mixed variance, yeah, I just did the formulas and we just go straight to the question. But let me explain the concept of the mixed variance so we will be able to relate well when it comes to solving the question. Now, when we talk about mix, so mix is just that you have a plan at the beginning, you have a budget. Say, I want to buy, I think we usually use the buns or the flour or bread also. Example. Now, let's say at the start, you felt like, oh, I need to make 10 breads, and this is how I'm going to need it. I will need maybe 3 kg of flour. You will need 1 kg of sugar, 1 kg of butter, and 1 kg of say yeast. I don't know the ingredients, but let's just have the let me use 311. Let's say you need 4 kg of flour, 3 kg of butter, that's 7, 2 kg of sugar, that's 9, and 1 kg of yeast makes it 10 kg of material that you will need. Now, that is your standard way of mixing it. That is the way you want to mix it initially. So now it's saying that of all the things you will use, flour will be 40% of my total usage. Remember, we are using a total of 10 kg, 4, 3, 2, 1, and flour will be 4 kg out of the 10 kg. So it means that flour will be 40 kg of our usage. Now, that 40 kg I just did is what I call, or is what we call the standard quantity here. Just somewhere here, you see budgeted unit of A over the total budgeted unit of material. We'll still come there. But now, eventually, when you got to the market, you felt like, oh, the flour that they have, now they are telling you that this type of flour is actually one that how do you used to say this thing? Oh, ones that swells or something like that. So they can tell you that, oh, this flour used to swell, oh, so you might not need up to the 4 kg that you initially planned. But this time the problem is that this one swells a lot, but it is not sweet, so you might need to buy more sugar. So at the end of the day, when you go to the market, you now decide that, oh, instead of buying 4 kg of flour and waste it, and buy I think the sugar is 2 kg. So you can decide to switch it and say, oh, I just want 3 kg of flour, and this time make my sugar also 3 kg. Now, when you are calculating it one after the other in the normal sense, you will realize that your usage will still be zero, in the sense that you are still using the whole 10 kg, because I'm still using the 10 kg, but instead of 4, 3, 2, 1, it is now 3, 3, 3, 1. 3 for flour, 3 for sugar, 3 for butter, and 1 for yeast. Now, what changed in this scenario is just the mix. It's the way you mix the material. You have a plan to mix it, but now you've mixed it in another way. Now, what you just did there is you've changed the mixture, and that is what will lead us to the material mix variance. So we just want to know, is it the same way that we planned to mix our material? Is it the same way we eventually mixed it at the actual production? That's what the mixed material, the material mix variance is talking about. Then the second one, which is the yield. The material mix variance is just your standard quantity of A. Now, A here represents your material A minus the actual quantity times your standard price per unit. And where the standard quantity is your budgeted unit of A divided by your total budgeted unit. Now, this bracket, what is inside this bracket, you can just call it your standard proportion. So your standard proportion is your budgeted units of material A divided by your total budgeted unit. And then you can now multiply that your standard proportion multiplied by your actual total usage. You'll see better when we get to the example. Now, for yield variance, we have two methods for computing yield variance, but I've never liked the input approach because that one is a bit longer and a little bit complex, might get confusing easily. So that's why I always prefer the output method, simple and sharp. So the yield variance is just saying that, oh, you are putting materials, you put in 10 kg. Now let me ask you, how many, now you know when we were dealing with when we were making our budget, you said our budget is for 10 breads or so. So that means anytime you put in 10 kg of raw material, you are expected to come out with 10 breads. Now you now ask yourself, in the reality, were you able to make just 10 bread? Sometimes you might put in 10 kg and at the end of the day you come out with 9 kg, or at the end of the day you might put in 10 kg and get just 9 breads, or you might put in that same 10 kg and get 12 breads. So now there's difference between your output, your standard output, which is what you are supposed to get, and what you eventually get. Now that difference is what we call the yield variance. So standard output minus actual output, then multiplied by the standard cost per output. Now note that your standard output is just your total actual material usage. That is, I am saying, oh, if I'm saying that 10 kg of input of raw material is supposed to give me 10 bread. So ideally, I'm saying I'm supposed to get 1 bread for every 1 kg of raw material. That's your standard material per unit. Now, let's say now, and I said, oh, I bought 20 kg of input. So normally, I'm expected to get 20 breads, which is 20 kg divided by my standard material per unit, which is 1 kg now. So you get, you are supposed to get 20 bread. But I can now process that 20 kg and get 18 breads. That means I'm short of 2. Or I can process that 20 kg and get 25 breads. That means I'm getting more than what I'm supposed to get, and that's going to be favorable, definitely. So that is what the yield variance is saying. Now see down there, I mentioned that note that material mix variance and material yield variance will always give you your material usage variance, which is a basic variance. Remember our variances: material, we have material price and material usage. Now this applies to labor and variable overhead too. So your labor mix variance and your labor yield variance is expected to give you your labor efficiency variance. Same thing for variable overhead. So that is that about the mix and the yield variance. So let's see. Should we solve a question first, or we should just, since we don't have much to do, so let's just solve this question. Now the question is directly from the icon pack. I did not bother to edit anything. So the question said product X is produced from 2 direct materials. Now you have material X and material Y. Remember, I mentioned that once you have more than a single type of a product, either material, either labor, either your output, you normally should do the advanced variance. So now we have 2 material for just this product X, but we now have material X and Y. And they said they are mixed together in a process. So the following information relates to the budget and output for the month of July. So the standard here, we have the standard on the left side and the actual on the right side. So for the standard, we were going to use 12 liters of material Y and 18 liters of material Y, which means we are going to use 30 units in total. And the standard price is there 250 and 300, while the standard cost is just the multiplication of the two. You will understand why we should have this later. So now the output for the standard is just 1. So that means that we are expected to use 30 liters combined now. That is 12 liters of X and 18 liters of Y to produce just one product X. Now the standard price is here and the standard cost is also there. Then they give us the actual. Now for actual, 984 units of material X was used, while 1,230 units of material Y was used, which gave us a total of 2,214 liters, and they produced 72 units. Now they said calculate the standard material mix and yield variance using the line by line method. I don't even care about the line and line method. ICANN will not specify a method to use for you, except for FR, where you'll be told to either use direct or indirect when you are dealing with your um, cash flow statements. But for the rest, I don't think I've seen any question what ICANN specifies a method to use. So let's just quickly go through the solution. So the first one is the material mix. I just need my formula at the back. Do I need to repeat it? I don't think so, but let me just bring it back. Oh, good. Okay. So now we are looking for the material mix for X and Y. So for X now, we are going to ask ourselves the first thing you have to compute when you are dealing with the mix variance. I did not even confirm if YouTube is fine. Sorry, please give me a minute. Let me confirm if I'm audible enough on YouTube. Uh, so those on YouTube, are you with me? Okay, let me continue. Hopefully they are with me. For X, I was saying, anytime you see a mix or yield variance, a mix in particular, what you need to first compute is your standard quantity. Like you want to really know now that your budget says you are supposed to use 30 liters in total for the material. But now that you are using 2,214 units, how many units of it is supposed to be material X? How many units of it is supposed to be material Y? You know that assuming you've used 30 for the actual units, we have just said, oh, 12 of it is supposed to be X and 18 is supposed to be Y. So that would have been easier. But now that you are not using 30, you are using 2,214. We need to know how many units were supposed to be X and how many were supposed to be Y. So that is where you bring in your standard proportion. Now, this is saying that your budgeted unit of A, now it will be X. So how many units did we budget to use for material X? In our budget, we said 12. So that's going to be 12. So 12 divided by, now in total, we budgeted to use 30, which is your total budgeted unit of material. So that will be 12 over 30. And this 12 over 30, like I mentioned, is what we call your standard proportion. Standard proportion. Okay. Now we want to now calculate the standard quantity now. So we've gotten our standard proportion to be 12 divided by 30. So your actual total usage. So you go back to the question and check how many units did I use entirely. So they used 2,214. 2,214 liters. Now this should give us how many units? Can someone quickly do the maths? Standard
896.4.
896. Let me just keep it like that. 896 liters. So now this is saying that out of these 2,214 liters that you eventually used, 896 of it was supposed to be material X. Now I don't even care how many units you eventually used, but for now,
sorry, the answer is 885.6. So 12 divided by 30 times 2214.
It's 885.6.
885.6.
Yes.
So that's 886.
856. Yeah.
Yeah, okay. Thank you. So let's do the same thing for y. So y now is going to be, now it's no longer going to be 12. Why? Because y we were supposed to use 18, not 12.
18.
So y is going to be 18 divided by 30. That's 18 divided by 30 multiplied by the same 2,214 liters.
1,328.
Yeah.
1,328 liters. So yeah, now if you add these two, even if you have more than two, once you add everything, you are expected to get back your total actual liters. It is a must. Once you don't get it, you've mixed it wrongly. So I want to believe this. I want to believe that's correct. So now we can now go ahead. So can you mute yourself? It's
Mr. Moses, please.
Thank you. Okay, I think everybody's muted now. Okay, good. So we can now go ahead to calculate our material mix variance. We've calculated the major thing we needed, which is the standard quantity. So now to calculate our material mix for A. See, someone is trying to join. So the material mix for A is going to be, now we said it should be your standard quantity, not A, sorry. X should be your standard quantity minus your actual quantity times your standard price per unit. So here is, what is our standard quantity? We were supposed to use 886. Now, how many units did we use? We actually used 984. 984. Now, before I multiply, I want to bring out something. Now, what's the standard price for material X? The standard price is 250 naira. Now, what is the figure that we have inside this bracket?
Minus 98.
No, 98 adverse. 98 adverse. You used more than you're supposed to use. Remember the concept of favorable and adverse. So for cost, when you spend more than you're supposed to, it is adverse, and when you spend lesser, it is favorable. So now there's a reason I brought out that 98 adverse. We'll get to see it soon. So what do we have here now?
24,500.
24,500. Now we can do the same thing for y. So for y is going to be 1,328 minus, that's 1,230, 1,230. Now multiplied by, how much is the standard price here? We have
98 favorable.
We have it to be 300. Now definitely we are going to get 98 favorable at 300, and the answer is going to be what?
29,400.
29,400. Yeah, favorable and adverse. Now, why did I bring out this adverse and favorable? Now, before you multiply by your price, the summation of all your mixed must give you 0. It is a must. It must give you 0. So if you add negative 98 and positive 98, you will definitely get a 0. Now, if you have 9 different raw materials, if you add all their mix together, note before you multiply by the price, because you are multiplying by different prices, the actual will not give you 0. But these figures, before you multiply them, must always give you 0. Note that you must get 0. So now this is what we call the material mix variance. We successfully completed that, so it doesn't go beyond this. There's nothing else. Just calculate your standard quantity, then do the mix, and you'll be absolutely fine. So moving forward to the yield. Okay. So we have our yield formula here instead of wasting time to paste. Nope. So the material yield variance is going to be like this. So what is going to be our standard output? Now remember, we said our standard output should be your total actual material usage divided by your standard material per unit. Now this question I've made life very, very easy for us, because they gave us the quantity required to make just 1 unit. So it means that we are to use 30 liters to make 1 unit, as simple as ABC. Now let's assume that what we have here is not 1 unit. Let's assume they said the output is 10 units. Now it simply means you were supposed to use 30 liters of material to make 10 units. So to get how many liters to make 1 unit, you do 30 divided by 10. So it means 3 liters to make 1 unit. Just divide the total material by your total budgeted production. Simple as ABC. Now since we all agree, or maybe not, but that's the answer, that 30 liters will give us 1 unit. We want to know how many units are we supposed to get from 2,214. So we said total actual material usage, which is 2,214 liters. divided by, now how many liters do we need to get one? 30. Now how many units are we supposed to get?
74.
So we were supposed to get 74 units. To get 74 units based on that. So therefore, so we will come down to now see our yield. Remember the formula again: standard output minus actual output. Now, what's our standard output? We said we were supposed to get 74 units, but how many units did we get? They said we were only able to produce 72 units. Somewhere right here, it said the output was 72. So minus 72 units. Now multiply by your standard cost per unit per output. Now note that I did not say standard cost per unit of material. I'm not talking about per unit. You see, this year is different from this year. This is per output. Now you will now go back to your question and ask, how much am I spending to make 1 unit of this product? They've given us here. This question is very straightforward. We have 8,400 now. In case this column is not provided, which oftentimes ICANN will not provide it for you, this standard cost column. So what you are supposed to do is what they've done. You multiply all your costs together as if you are computing a standard cost card. You remember the first class. And whatever you get as your total raw material will be your standard cost per output. We still solve more questions like that to get our standard cost. So here they've given us 8,400 as standard cost per output. Now again, in a situation where your output, the budgeted output is not 1, you should always remember that you are to divide by whatsoever number you have here. So if assuming this place is 10 at this output, assuming we have 10 units there, just know that you have to divide this 8,400 by what is it again? By 10. That's just assuming you have 10 units here. But since it's 8,400 divided by 1, you still get 8,400. So this is going to be 8,400 naira. And how much do we have?
16,800.
16,800. Now, is this going to be favorable or adverse to us? It should definitely be adverse. Because they gave you 2,214 liters of material, and they were expecting 74 units from you. But guess what? You were only able to produce 72. It shows you are not that efficient. So that is the yield variance. So let's go on to the next set, which is sales mix and this quantity variance. So I will not talk much about the sales mix because it's actually the same thing as the material mix. The only difference is this one you are multiplying, instead by the price, you are multiplying by the standard contribution or profits per unit. Remember, when we were computing our sales volume variance, this is what we use. So I will just use an example to explain that. You are following exactly the same step. If you notice, you have the same formula: standard quantity minus actual, while your standard quantity remains your budgeted unit divided by your total budgeted sales units, then times the actual total sales. That is that. So where we are going to dwell on is this quantity, the quantity variance. So the quantity variance is just saying that, I mean, it's one of the straightforward one you can get. It's just your budgeted sales, your total. So if you plan to sell 20 of material A, 15 of material B, 10 of material C. That's in total, you plan to sell, I think that's 45. Oh, yeah. You plan to sell 45 units. And in reality, you sold just 15 of material A, 20 of material B, and you sold 20 of material C. Now you sold 55. You plan to sell 45, your actual is 55. Just subtract the two from each other, and then you multiply by your average contribution per unit. Now, the average contribution per unit is in bold because that is an entirely new concept. We've not talked about that before. Now, average contribution per unit is just your total budgeted contribution. Now, you add the contribution you expect to make from material A, you add it to the total contribution you expect to make from material B, to the contribution you expect to make from material C. I mean, not material, sorry, this time. Product A, product B, product C, product D, product Z, as much as you want. Then divide it by the total units you plan to sell, which is the addition of the unit of A that you plan to sell, plus the B, plus the C, plus the D, till the Z. So when you get that, you should get your average contribution per unit, and that is what we'll be making use of here. And in the last two advanced variance question. So that being said, I've gone almost 40 minutes. Let's just take a break before we go to question. Before we solve a question on this. I'm still. Oh yeah, good. Does anybody have any question at this point before we move forward?
Yes, I have a
Yes,
question.
sir. I have a
Hey,
question.
hold on. Just raise your hand. I will call you, please. Let me mute out first. Okay, I think I saw Michael first. Yeah, Michael, your question.
Good evening, sir.
Yeah, good
I
evening.
totally understand all of them, but this place that after calculating our mixed variance, after getting our advance of 98 and favorable of 98, why are we multiplying by their costs, by their price again? Like the 24,500, what was it called? Like, I don't understand what we did there. Like, I don't understand.
You know that this figure right here, this 98 and 98 favorable, the 98 adverse and 98 favorable are just your material. And don't forget, we are trying to draft our profit statement, or we are trying to reconcile our profit. We don't reconcile material in your profit statement. It is the value, the figure,
Okay,
the
we are
amount.
trying to get the
So we are
value.
trying to get it in monetary value.
Okay,
So
okay.
if you look at the formula, you see that at the end of the day, you were supposed to multiply by your standard price. So you are trying to convert it to monetary value. So okay, thank you. Philemon, John. Is he here? Nika.
I'm
Okay,
here, sir.
okay.
Yeah.
All right. Yeah,
Sorry,
John.
I mentioned before. Thank you for the work done. I'm having a bit of a challenge with this formula. I just want to confirm either we can also use the formula of the revised standard quantity minus the actual quantity multiplied by the standard price. I don't know.
Revised actual quantity.
The standard quantity minus the actual quantity, then multiply by the standard price.
Are you talking about the mixed variance?
Yes, sir. The
I mean,
material
it's just the naming that changed. I use standard quantity. You call it reversed actual quantity. It's just the name that you change. How do you get your revised actual quantity? You are still coming back to this formula at the end of the day. So it's just the naming that you change, and of course, it's allowed. There's no one way to solve it. As far as we get same answer, definitely allowed.
Okay, thank you.
All right, Nneka, Chioma.
Good evening, sir. Thank you very much, sir.
Welcome.
So my question is, I want to ask why we divided the 8,400 by 1. Like, why do we divide
Yeah.
it?
Where did you divide?
This one, this total
Oh yeah.
8,400.
Okay. What was the speed? Well, I can get myself back. Please. Okay. So what I was saying is, not all icon question will give you a standard output of 1. So everything we did here was easy, not very easy, but it was easy because they just gave us 1 unit here. So I was saying, assuming you don't have 1 here, let's say you have 10. So that means this standard cost card must have been for the production of 10 units. So, and you remember the formula says per output. Where is it again? Did I switch them? Sorry, I think I switched this slide. So, okay, yeah. See, the standard said per output. This per output simply means for 1 output, 1, which I don't need there. And if this table had given you the cost card for producing 10, it is expected of you to convert it to 1. So, and how do you convert it to 1? You do the total, which is this 84, divided by whatever you have as your unit. If it is 10, you divide 84 by 10. If it is 20, 84 by 20. If it is 500, 84 by 500. But since this question, we have 1, that's why I did not bother to divide. Because if you had divided 8,400 by 1, you still come back to the 8,400. So I was explaining, in cases where you will not have 1, you have to divide your total cost by the number of units produced. Do you understand me now?
Yes, sir. Thank you, sir. Sir, this standard
Okay.
cost can also be used as budgeted, right?
You
Like
said,
like that standard cost is like also a budgeted cost. Like it can.
yes. You say the same thing.
Okay, all right. Thank you, sir.
Okay. I didn't. Okay. Thankfully, hand is down already. So, Chairman, you can put down your hand too. So that we'll just continue. Multiple people want to join the call, but where are they? Okay, I can see them. So let's just continue to solve a question on the sales mix and the sales quantity before we go to the last one. So okay. So for the sales mix, we said the example here, the following information relates to the sales budget and actual sales volume results for X Limited for the month of March. So their budgeted sales for for product X was 240 units, for Y is 140, for Z is 120, unit contribution 50. That's your contribution per unit now. 50, 70, 60, and blah blah blah. You have a total contribution and like that. So which gives us a standard. They've made this question way too simple, but just for explanation's sake. So we have the actual sales to be 20, 220, 180, and 600 as the total. So of course the question is going to be to calculate the sales mix and the sales quantity variance. It's the sales mix and sales quantity variance. So our solution is going to be as straightforward as possible. So again, the first thing we need to compute, remember I mentioned that anytime you have a mix variance, what you need to compute first is your standard quantity of each of the product or material or labor, as the case may be. So we're supposed to get standard quantity for, I think it's material X, Y, Z. So standard quantity for X now is going to be, now open your big brackets. Now, what is the budgeted unit of material? A of product, why do I keep saying material? Product X. In the budget, they said we were supposed to sell 240 units of product X. So we were supposed to sell 240 units of X. And what is the total budgeted sales units? Total was supposed to be 500. Now again, this right here inside this bracket is what we call the budget, the standard proportion. Standard proportion. So we can multiply that by now our actual total sales. Our actual total sales. So now actual total sales in this sense is how many units? We have 600 units. 600. Now this should give us what?
288.
So 288. Nope. So 288 units. 288. I'll just do a shortcut. So here is going to be for Y. Now, what is the standard quantity for Y? How many units of Y were they supposed to sell? They were supposed to sell 140. So 140. So what do we have? And for Z was supposed to be 120. So what do we have for
168 for Y? 168.
168. And this should be
144.
144 units. So life is easy. We've gotten this. Then we can now go ahead and calculate the mix.
Please, the third one, standard quantity for X.
Oh, sorry.
Z, not X.
Z. Okay, thank you. So the mix variance for Y now. Sorry, X first. X. So we said our standard quantity minus the actual quantity. So standard quantity, we said 288 minus. So looking at the actual, they sold 200. They sold 200. And that is definitely giving us 88 favorable. Now don't forget, this is sales. We are not dealing with material. Assuming we are under material, this would have been adverse. But it's adverse. Sorry, it should be adverse. Assuming we are dealing with material, this would have been favorable because you did 200 when you're supposed to do 288. It would have been favorable under material. But for sales, you sold 200 when you were supposed to sell 288. It is definitely an adverse. So we keep that as adverse. Now multiply by, now note this is your standard contribution per unit. So go here for look for your standard contribution per unit. They've given us on the second row. So the contribution per unit is
50,
15 error. So how much is that going to be? 400, 440, I think.
Yes, 400 for 40.
440. Okay. No, there should be
one. 10.
4,400.
Yeah. So same thing for mix variance for Y. Open the big brackets. They said you were supposed to sell 168, but you sold, I think I saw 120, and that should give us That's 32.52. Yep, 52 favorable multiplied by how much is the standard contribution here? 17 naira. 17 naira.
3,640.
3,640. And this is favorable. This is, don't ever forget your sign. If it's favorable, always include that it is favorable, and if it is adverse, always include it. It has its own mark. And for the last guy here, 144 to subtract from 180. Subtract from 180.
36 favorable.
36 favorable. Now you can see again that if you add 88 adverse with 52 favorable and 36 favorable, you should get 0. It is a must. You must get that 0. Once you do not get 0, just know that your mixture is wrong. Maybe you've added too much sugar. Okay, so 36 times
2,160 favorable.
160.
favorable.
160 favorable. So this is our mix variance for the three of them. As simple as it can be. So the final one is the sales quantity. Variance. Now, we're not bringing the formula because most of the things have been given to us in the question. You know, the formula said our budgeted sales unit minus our actual sales unit multiplied by our average contribution or sorry, something. Did I delete it? Okay, so every single thing that we need here is exactly in the question. They've done the whole calculation for us. They've made our life way easier. So we can just pick what is the total. I think I should include the fact that it is total, and this should be also total. So just bring the two totals here: 500 and 600. So 500 minus 600, and like I mentioned again, they've given us the average contribution. Now I want to believe, so this is it right here. The standard average contribution per unit is 58. Now I want to believe that we all understand when to use average contribution and when to use average profits. I want to believe we all do. If you don't, you can keep the question for when we enter question and answer session. So 100 multiplied by so
5,800 favorable.
Let me bring it out here to say 100 favorable. Then multiply by 58. And that should give us
5,800 favorable.
5,800 favorable. So here goes our sales mix and sales variance. Now for markets, which is the last two advanced variance that we have, the market share and the market size variance. Now what are these two talking about? Now these two ideally are not something you can control, but to an extent you can also control them. But what is market share and market size variance talking about? I'll start with the first one on the list, which is the market size variance. Now, the market size variance is saying that, oh, when we were doing our budget, of course, you cannot expect to sell to the whole market, but you have a projection that, oh, I think okay, say you are selling maybe pawpaw for drinks, and then you are going to a seminar. So you felt like, oh, so in this seminar, I think 1,000 people should be present, and of these 1,000 people, 500 of them should buy cold drinks. Now it means that your total market size, if you are selling drinks, your total market size is actually 500. But it should be so unwise of you to say that means I should be able to sell 500 drinks, except, of course, if you are the only person in the market. But in a fair market, you cannot be the only one, or else the market will be fair. So let's say you were thinking, oh, if 500 people are buying drinks, with all my strength, with all the people I know, I should be able to sell 200. Now it means that you have a market size of 500. Now let me now keep the 200 for later. We'll come back to it. Now eventually the seminar happened. Now you realize that maybe they changed the location, and they now went for a higher capacity. Instead of 1,000 capacity, they were able to secure a place that could hold 2,000 or 3,000 capacity. And of course, the more people that attend, you should expect more people to buy drinks. Now, instead of 500 people buying, now 1,000 people actually bought. Now, it means that between when you are planning and when the event actually happened, your market size has changed. Now, that change in your market size, directly or indirectly, will affect your sales, and in the long run, affect your profit. So you want to also know what size of my what amount or what size of my sales changed simply because my market size changed. Now that is what the market size variance is talking about. Now that is where you see the budgeted market size is just the 500 that you thought will be around, then minus actual market price, which is now eventually the 1,000. Now this standard market percentage is now saying that, remember, when you budgeted that 500 people were going to be around, and that person mutes his or herself, I don't know who the person is, I don't want to switch back. I don't understand this, but okay. So as the person, I don't think the person has muted.
Yeah, please mute.
Don't worry, I muted the person already. Okay, thank you. So now, you said you were going to sell 200 or 500. It simply means you were supposed to sell 40% of the market. How did I get that? Simply 200 divided by 500. So if 500 people are coming, I should sell to 200. So my market percentage is 200 over 500. Now that the market has increased to 1,000, of course, I'm not expected to still sell 200. That would be inefficient of me. I am now expected to sell more. And by more, it means you are expected to maintain the same level of sales. Why are you unmuting yourself? You carry our okolo also. I muted you, you unmuted yourself, please. So yeah, as I was saying, now your standard percentage is expected to remain the same. So if you are going to sell 200 to 500, of course, since the market has now doubled to 1,000, your sales is expected to also double to 1,000. Now you're expected to sell that same 40% for 1,000. So now you're expected to sell that will be 400. And in the same vein, if market size reduced from that 500 to say 300, you're expected to maintain that same 40%. So now your sales is expected to be around 120. That is your market size variance. Now the average contribution of profit per unit remains the same thing we used in the sales quantity variance. So as you can see, the standard market percentage is just your budgeted sales unit over the budgeted market size. You want to sell 200 out of 500 people that will be around. That's your market percentage. Now, the second one is just an extension of the first one. Now, this one is the market share variance. Now, out of 1,000 people that came, how many people were you able to sell to? Now, the share variance is just the simple formula is standard sales minus actual sales times your average contribution per unit. Now, what the standard sales is saying that since your market size has changed, the number of units you are expected to sell to has changed. Now, what is the new expectation? So your new expectation is that even though the market size changed, you are expected to maintain that same percentage. And remember, our percentage was 40%. So now the market is 1,000. So it means that we are expected to sell 400 units, which is 40% of the new 1,000. Now you will now check if I'm expected to sell 400. Now, how many did I sell? So did I sell 200? Did I sell 300? Did I sell 500? Now that is where your share variance comes in. Are you able to outperform your expectation or you performed below expectation? That is the market share variance for you. So that is that about the two markets. Now note again, I said the market size and the market share variance will give you sales quantity variance. So these two should give you your sales quantity variance when you add the two of them together. So yep, going on to the last question from the examples before we dive into the main questions. Okay, let's take it this way. Now, Brunco Nigeria Limited prepared a sales budget based on an estimated market size of 200,000 units. Now, that's the budgeted market size, and a budgeted market share of 25%. Now, the standard contribution per unit is 14 naira. Fine. Now, at the end of the year, it was estimated that the actual size of the market during the year had been 260,000 units. So the market size shifted, and the actual sales in the year was now 61,000 units. You are required to compute the total sales volume variance, which I will skip. I don't need that. Then you calculate the market size variance and the market share variance. Now, the beauty thing about, not like the beauty, but the thing about this market size and market share, why it is different from the other variance, which is the mix, the quantity, and the yield, is that either you are dealing with more than one or you are dealing with just one product, you can still calculate market size and market yield. You don't need to have more than one product to be able to calculate market size and market yield. That's the only thing that makes it different from the other ones. But at the end of the day, it is still part of your advanced variance. So let's go. Oh, there was no slide for solution. Solution. Okay. Let's bring our guy in. No. Control V. So just bringing back our formulas so that we can always have them handy. So, and as usual, what we'll compute first is the figure that we have. Nope, this is, what's this? Let me just leave it like that. The one that we need down here, we need to we don't even need to compute it. The question has given us. They've given us the standard market share to be 25%. So life is even very, very easy. And if in case the question did not give us, they are giving us your budgeted market share. I mean your budgeted sales. So and what do we do to get the share? Just divide your budgeted sales by the budgeted market size. Life will be easy. So so in this question now we can just calculate the market size variance. So be equal to, now what was the budgeted market size? They said 200 people will be in the market. And guess what? They lied, because 260 people were in the market. Yep. So that is the absolute budgeted minus the actual. So we multiply it by our market percentage. We said we were expecting to sell 25% and multiply by your average contribution. Now, can anybody tell me why we are using standard contribution when I said here that there is a big difference? I think I said here that you should note that there's difference between standard contribution and average contribution. And this question gave us just standard contribution, but we can still use it here. Can anybody just bring or maybe just an idea? Why do you think this is so? Why? We should all agree that there's difference between standard contribution and average contribution per unit. It is that is a fact, no dispute. But why can we use standard contribution here and we cannot use it in the other example? Why?
Because they are not selling multiple products.
Exactly. Simple. That's the straight answer. Because you are not selling multiple products. So you only get average when you have more than one. You cannot get average of one. The mean of one will still be that one. So there is no calculation of average. That is why we are using the standard contribution per unit. Remember, if we are going to calculate the average standard contribution, we have gotten the standard contribution for products A, B, C, D, and then divide everything. But since it is only product A or whatever this product is that we have, its standard contribution automatically becomes the average. So that is why we are keeping 40, sorry. 40. And what do we have?
600,000.
That will be 60,000 times 25. That's 15 times 40. Yep, 600,000. 600,000. Now, is this going to be favorable? Definitely favorable. Why is it favorable? Your plan is that 200,000 people will come to the market, but surprisingly, 260,000 people came around. So, of course, you are expected to sell more than what you have. So, your whatsoever you have budgeted, so your variance is supposed to be favorable. That is for that. Then market share variance now is going to be what do we call it again? So we said, okay, I want to bring the formula first. So we can go ahead to calculate our standard sales first. So, we said the market share variance should just be your standard sales minus your actual sales, then times your average contribution per unit. Now, your standard sales is going to be your standard market percentage, which in this case is 25%. Then multiply by, now what is our actual market size? Our actual market size happens to be 260,000.
260,000.
So that is 50 plus 15, that's
65,000.
65,000 units. So before, you were supposed to sell, I think that's 50,000. When market was 200, you're supposed to sell 50,000. But now that the market is 260, you are supposed to sell 65,000 units. So our share variance is going to be the 65,000 units minus, now how many units did they eventually sell? They sold 61,000 units. Multiply by the same 40. So we have 4,000 times 40 plus 16.
160,000 adverts.
160,000 adverse, yeah. And why is it adverse? Because now the market has gone up. We told you, or you yourself calculated that you were supposed to sell 65,000 units, but somehow you could only sell 61,000 units. We don't care whatever happened, but the fact that you were not able to make up your quota, it means you were not efficient enough, and it is an adverse to you. And that is that you will have 160,000 adverse, and that is that. Now, I wanted to do something. This same question, I want to justify this market size plus market share should give us sales quantity. Now, remember the formula for sales quantity is just, by the way, you don't need to do it. Remember, market quantity is your budgeted unit minus your actual unit multiplied by your standard contribution per unit. So let's just do a quick check. Remember, our budget was to sell 25% of 200. Let me just put it here somewhere here. Quantity variance. Remember, our budget was 25% of the total market, and the total market was supposed to be 200. So our budget should have been 50,000 units. So our quantity variance now, which is let me just call it quantity variance, because I'll still use it anyway, should be your budgeted units, which is 50,000 minus the actual, which is 61,000. You know, we sold, this is where I'm getting the budget, 25% of 200, and the actual is what we have here, 61,000. If you close these brackets and multiply it by 40, which is the standard contribution or the average contribution, you should get 440. Is that correct? And it should be favorable. Is it correct?
Yes, it is correct. Yes.
Yeah. So if you add 600,000 favorable and 160,000 adverse, of course, you are getting 440,000 favorable. So that's just what I'm trying to, this is what I'm trying to justify, that your market size plus your market share should always give you your sales quantity variance. So now that leads us to this form. This is for your consumption. I don't need to explain, and you will get to need them when we are doing questions that have to do with reconciliation of variance. So you see that I said here that material price plus material usage will give you material cost variance. Labor rate plus efficiency will give you the cost. Fixed overhead, capacity, and efficiency gives you volume. Fixed overhead, volume, and its efficiency. Nope, not efficiency. Nope, it is the expenditure. Plus the expenditure will give you the cost. Material or labor or variable overhead mix plus its yield will give you the usage or its efficiency. Sales mix plus sales quantity gives you volume, while market size plus market share gives you the sales quantity. Now, the idea of this is that when you are dealing with reconciliation, if you've calculated costs, just know that you don't need these other two again. Because if you calculate these two and you are bringing in cost again, it means you are writing the same thing twice and your reconciliation will never reconcile. So same thing here. Once you calculated market size and market share, just know you don't need sales quantity, or else your reconciliation will not reconcile. So yeah, that brings us to the end of the explanation part of variance analysis. Now there's one other thing, but I always like to come back to that because again that would take us a whole class, which is the operational and the planning variance. So I always like that after the class, and if you like, you can study it on your own. You can study it separately. I can barely ask that part, but if time permits, we can come back to it at the end of the whole class. Looking at the time, we will not be able to take to start any question. And I think it's time to have a little discussion before question. Now, how does this sound? Can we have a class on Sunday afternoon? I think you always have class from 7 to 11 or so. But can we have one on a Sunday afternoon before the normal timetable? Is that possible, or how feasible is that going to be?
Yeah, it's class on Sunday by 4 p.m.
Should I just put it on the group as a poll? Let's majority
Class
decide.
on Sunday by 4 p.m., sir. There's
Bye.
class on Sunday by 4 p.m.
4.
Yes, sir. 4 p.m. and 7 p.m.
So there's no class 9 p.m. on Sunday. I think the timetable was supposed to be 7. Was supposed to
The
be
person
7.
that you take by 9 brought it earlier. He's taking from
Oh.
4.
That's I mean.
On Saturday is free.
Okay, I think Saturday will be fine then. Okay, but we'll still write it on the group anyway. We'll take the poll to see if we can go ahead. I mean, we just need extra class to cover a lot of ground. Okay, so at this point, if you have any question from the start of the class, from standard costing itself, maybe you've gone through the video, please make sure you've gone through the video before you ask question. So from standard costing to variance analysis, which is the first one, to the second variance analysis, to today's class. If you have any question, I think now is the best time. to go ahead. Olamilokun Ibrahim, think yeah, you can talk now.
Okay, thank you, sir. So my
Uh,
question goes this way. The sales quantity variance, the 5,008 that you got, is it favorable or adverse?
is definitely favorable. And why is it favorable? It is simply with, sorry, where did I get 5,000 again? I was thinking is this last one. Oh, this one, yeah, it's favorable now. Because you were supposed to sell 500, you sold 600. See our total here. In the budget, our total was that you were supposed to sell 500 units, but you are able to sell 600 units. It's favorable to you now. It brings more profit to you, more money. I mean, it makes you happy. So that's why it is favorable. Do you understand that?
Oh, okay, thank you, sir. Thank you.
You're welcome. Okay, yeah, Michael Chimamanda. Hopefully, I'm calling your name correctly, but yeah, you can
Yes,
go on.
you're calling it correctly. I have two questions, sir.
All
One,
right.
you said we ask you the difference between the contribution and profit, that they are used in different places that people use. I don't understand. So that's what
You,
I'm asking now.
you do not forget that. Okay, yeah, good. Yeah, next. Yeah, you say you have two. Go on with the second one. I'll just
Yes,
take
I'm
it.
looking for I wrote it down. No, answer the first one. Let me look.
Oh, okay. So the answer to the first one is actually simple. I'm trying to see if there's anyone on YouTube that has a question because I've not been checking YouTube today, which is unlikely. Which course are we? Ah, we are doing PM. Thank you. And PM means performance management, by the way. Um, which other question? I don't think we have any question. Oh, sorry. Uh, okay. There's no other question on YouTube. So your question between the difference between standard contribution and standard profit. I mentioned it in one of the classes. I think the standard costing class that you can be asked to use standard contribution or standard profit depending on the costing model that the company or the question asks you to use. So if you are dealing with marginal costing, so you should know that you are supposed to go with standard contribution. So you don't factor in fixed cost. But if you are dealing with absorption costing model, you are dealing with standard profit. And in a case where the question is silent, they do not tell you to use marginal, they do not tell you to use absorption. You can choose whatsoever you like. And I will always advise you go with the standard contribution per unit. It's always the easiest part. So that's the difference between standard contribution, when to use standard contribution and when to use profits. Again, standard as I was saying, marginal costing goes with standard contribution, while absorption costing goes with standard profits. Okay. Have you seen your other question now, or do we have any other person that has a question?
Thank you, sir. Thank you, sir. You've answered the whole question. Thank you.
Okay, you're welcome. Okay, I don't see any hands up. I don't see any hand up tonight. So, and I think this will be the end of the class for today. So hopefully we get to meet on Saturday where we can solve questions. I'll send the questions to the group ahead of time if eventually you all voted for a class on Saturday. So and this brings us to the end of the class. And after standard costing, the next topic is going to be activity-based costing. And for that, I think I will bring back the video I did in the last diet. So I'll just share the link again on the group. Of course, that's going to be after variance analysis so that we don't mix them up. I will share the link. Then what we'll come back to do in class to save time is solve questions. So I will just solve more questions to, or let's say the first 1 hour will be, or 30 minutes will be to answer any question I don't understand or any points I don't understand there, then we can now go on to solve more questions. So I mean, it will just be building up over the years, and before we know it, one diet will be done with all ICANN question. So that is that. So at this point, I think I can say good night to everyone of us. See you next week or Saturday.
That's right. Night.
Thank you, sir. Good night.